from an economist's perspective, is there such thing as the disinflationary boom or the deflationary boom even?
So this is about, making a distinction between now and what comes next.
Yeah, yeah.
Now, clearly, it is about the higher levels of investments
Right,
that
right.
from
Clearly, right
AI.
now, it's pushing everything up. But let's imagine 10 years from now and we've done it. We have this incredible, and somehow we've solved all the sci-fi scenarios so that the AI doesn't want to kill us all, etc. Let's just imagine the rosy scenario in which we have
I
this like
feel like there are some
incredibly
under-discussed risk factors in this
no, but
outlook.
right, like let's just
Assuming the
say
robots don't
Ass-
kill us.
assuming we solve that and the AI works on our behalf and it does what we want it to do and it can create incredible material gains while also very delivering it cheaply because it's just one AI, etc. Is that a contemplatable scenario from an economist's perspective?
There is absolutely a scenario where we could be in that wonderful place with higher productivity growth.
Yeah,
At the same time, we don't have civil unrest or,
right.
you know, rogue forces
Yeah,
using AI for ill. That is a scenario, but I do not know a single person who will put a probability on that scenario and say that that's going to happen, with a significant amount of certainty.
yeah,
There is a very high degree of uncertainty, and there are several who also believe that it's yet to be seen whether there is going to be any major productivity gain of the kind that, there are analysts who believe that productivity could go up by 2 percentage points a year, over and above where it is right now, which is around 2 percentage points a year. I mean, that is huge. There is no evidence right now of that kind of a productivity wave coming through. So
hmm
it's early, but I use the technology and I find it terrific. I mean, it's been really great for my own productivity. It's not affecting my wages or anything so far, but it's there. It is very valuable technology, but there is a lot of uncertainty.
Hello and welcome to another episode of the Odd Lots podcast. I'm Tracy Alloway.
And I'm Joe Weisenthal.
Joe, the big story in markets right now has to be one of the big stories, the bond market sell-off. By the way, as I say that, I just got this massive feeling of deja vu because I'm pretty sure we've done a few episodes where I've started out saying the exact same line.
Well, I mean, one, obviously, this is sort of one of the trends of our time, which is that after a decade pre-COVID, where we just sort of assumed the rates were going to head lower, that is obviously, there's been a regime change, as economists sometimes like to say. And so now we have rates pushing higher again. They've come back a little bit in the last couple days, but that's not really the point. The point is, it is this global phenomenon around the world, rates going up. I would still say probably the big story in markets is AI and memory and chips. But if it weren't for that, everyone would be talking about interest rates higher in almost every country in the world.
So here's the thing. I actually think AI and
Yeah.
the rate sell-off is kind of connected. So,
Okay.
we're talking about yields going up generally in developed markets, and we've seen that recently. I know we saw, for instance, the long end of the UK gilt market hit like
Yeah.
the highest since 1998. The 10-year US Treasury yield was kind of inching up towards 5%, but it's come down. Mostly, a lot of those yields have been moving in line with the
Yeah.
oil price, right? So a lot of people will say that this is just because oil's going up,
Sure.
that's inflationary, maybe we'll get higher rates, and so this is why yields have been backing up. However, there is an argument, I'm
Yeah.
seeing more and more people make this one, that what's going on is actually a repricing of something, less transitory.
Yeah.
Am I allowed to say that word anymore? Less transitory and something more secular
Yeah.
in what's happening
Yeah.
with the rates market. Something that's more about the massive amounts of capital that
Yes.
AI is actually consuming and having a crowding out effect on sovereign
Yeah.
bonds, or maybe something that's more about, the ability of the developed world to actually finance itself
Yeah.
in the longer term. And so you're starting to see some of those bigger themes creep into the discussion about the bond market sell-off. This idea that it's something else is happening here, something more than the oil price.
Totally. Actually, just speaking of the nexus between interest rates and AI, Torsten Slok has a good chart out came out this morning, pointing out essentially that one thing with AI is the sort of FOMO aspect, not among investors per se, but about companies
Hmm.
and not wanting to let their models be 6 months behind. And so they'll pay whatever the cost is to catch up. And therefore, he argues that perhaps higher rates do not have the slowing effect that they might have had in another cycle,
Hmm.
because it's like, well, yeah, it's no fun to finance this data center at higher rates. But if the alternative is being consigned to the permanent underclass when the other company builds the most advanced model, you're going to do it nonetheless. And so, yes, between oil, between the AI boom, between demographics and the challenges of sort of resourcing for care of the elderly and the infirm, between all of these things, resource nationalism, building up things, that we are in this real secular shift and we have to understand it better.
Yes. So I am very happy to say we do, in fact, have the perfect guest to talk about all of this. We're going to be speaking with Gita Gopinath. She is, of course, a professor of economics at Harvard University, but also famously the first deputy managing director of the IMF. So truly a perfect guest to speak to, someone who's been talking about, a
Yeah.
secular change in the bond market for quite some time. Gita, thank you so much for coming on All Thoughts.
A pleasure, Tracy and Joe. Great to be on your show.
So what's your take when you're staring, presumably, on a minute by minute basis at a chart of the US 10-year yield? What are you thinking?
I mean, firstly, I think it's absolutely right to start with the conversation about what's happening in bond markets, because frankly, despite all the many different shocks going around in the world, I actually do think the one that's most worrisome is what we see with public debt levels everywhere in the world. In the US, we've seen yields go up. It's a combination of things. You just talked about all of them, which is one is the fact that inflation is now expected to be higher. And there is a sense that the real rate at which the economy will stay, at a somewhat stable level of inflation is higher. So the real interest rate has drifted up. The R star has drifted up from pre-pandemic when it was like 0.5 percentage point. Now it's 1 percentage point. But on top of that, you have the premium that's coming from the risk of inflation, from, very importantly, the large amount of fiscal, the large fiscal deficits that the US is running and is projected to continue to run into the foreseeable future. And of course, the third element, which is the AI boom and the expenditure, the capital expenditure that's being undertaken for that, is also shifting the R star up to maybe even higher than 1 percentage point. So because of all these reasons, we've suddenly moved away from the pre-pandemic period of low for long interest rates and what we were talking about, the end of, I think we have the end of secular stagnation at this point. Secular stagnation was about the fact that there was not enough investment happening, especially in the private sector. That is no longer an issue anymore. So because of the combination of inflation, AI boom, fiscal deficits all over the world, high public debt everywhere, we are seeing yields go up, and that's true in the US too.
What changed? I mean, I want to drill into all of these specific things. But, let's start with like the high level of public debt. That was a thing that people were talking about quite a bit prior to the pandemic as well. And rates just kept going lower and lower, including famously in Japan, where debt to GDP levels are even much higher than they are in the Western world. And that was sort of famously known as the widowmaker trade because rates kept going lower. What changed between 2020, pre-2020 and post-2020, such that this suddenly, in your view, and perhaps the market's view, this became an important thing that was not perceived by the market as being important pre-COVID?
A few things changed. One, the AI boom was unexpected. That was not something that was being priced in markets pre-pandemic, for sure. That big increase in demand for capital coming from the private sector is a big change. The other big change is the fact that fiscal deficits are now projected to stay at levels that nobody was expecting the US to run close to 7% fiscal deficits for the foreseeable future. that is another important factor. And the third is the composition of who's the marginal buyer of this debt. So we had a period when central banks everywhere were buying uh, uh, government debt, and that also helped keep interest rates low. In fact, that was part of the strategy of how to strengthen the economy. Quantitative easing was part of the toolkit, and so that helped keep interest rates low. But that's changed, and now we have the central banks everywhere who have either stopped buying or they're running it down, like it's happening in Japan. And the marginal buyer are the more volatile investors. Hedge funds in the US are the market makers over here. And so whenever there are any shifts in global market conditions, you see a lot more rate sensitivity than you would have seen if it was mainly official credit flows. And by the way, that's also true about capital flows coming into the US. Previously, the buyers of US treasuries used to be foreign central banks. They're not doing as much anymore. It's mainly coming from non-bank financial institutions from the rest of the world. And so they're also much more volatile and fleety. So you're going to see just generally higher volatility in the yield curve.
Can you talk a little bit more about the AI boom? Because we hear people talk about a crowding out effect. And I think this is actually like something that is just starting to get a lot of attention. But the proportion of issuance in the corporate bond market that's coming from AI companies or AI related, investment right now is just insane. And you mentioned Torsten's Slock chart. Torsten is going to be at our upcoming.
That's right.
We're recording this on May 27th, our upcoming live show in New York. And so I've previewed some of the charts he's going to be sharing there. There's a chart there that shows basically the proportion of AI in the corporate bond market. It's now 50% of all investment grade issuance year to date.
Wow.
And in even junk rated debt, it's creeping up to like almost 40%. Wow. So this is a significant amount of debt that's being issued into the market. Is it reasonable to think that investors are maybe going to think like, well, I'll buy some big tech, mega cap IG debt versus a US Treasury?
At least when we look at the pricing in markets, that seems to be the case, especially when it comes to equities. Everybody wants to have a piece of the AI boom. And yes, I think there is that sense that, well, this is a sector where we could really see real gains, especially in terms of productivity increases and profitability, and that's going to help. That's going to be something that they want to be a part of. So there is that demand for corporate bonds and for U.S. equity, which is coming again both from domestic investors but also from international investors, where AI is the trade. I mean, that's where all the dynamism is, and that's where people want to park their money. Now we've pointed at all the reasons why rates are likely to stay high, but I just want to point out that since we still have the ongoing Iran conflict and we still have the Strait of Hormuz closed, if that is not resolved and you end in any time soon, like the next month or so, and you see a even steeper increase in oil prices and crude prices going up to say $160 a barrel, which is what some of the projections would be in that case, then we could see much more demand destruction than we're seeing today, and we could be back in that space where, at least at the short end, interest rates are being cut pretty rapidly.
I want to, on this question, going back to the effect that the AI build out is having across rates and bonds and so forth, I want to sort of get some clarification here of what either you or what economists mean when they talk about, say, like crowding out, because there's one version of it that is like, okay, there's a lot of debt being issued right now by very highly rated companies, probably yields a little bit more than U.S. government bonds. That is attractive for investors, perhaps. And maybe that has some sort of crowding out in the financial markets. The other way that I tend to think of crowding out is that these the AI build out, it's like They're taking up all of the wind turbines. They're taking up all of the trucking capacity to get the goods to the data centers. They're taking up all the skilled contractors and laborers within the regions that these data centers are being built. And that creates inflationary pressure that adds to the strain. And therefore, all things being equal, that says higher inflation, therefore higher rates for longer to maintain that. Which of those two models, whether it's the sort of financial markets version or the sort of real economy version, is a more useful way of thinking about that linkage between private and public sector spending slash debt?
So both of those are in play right now. So that's
Okay.
the difference between what's happening to real rates versus what's happening to nominal rates,
Okay.
and what's happening to the pricing of the Fed rate path, right? So the first channel that you mentioned, which is just the fact that there is so much of demand from the private markets, from AI investors for AI companies for capital, is going to raise real rates. Even if there is no effect on inflation or inflation expectations are not moving, you should expect to see real rates rise, and that's certainly we're seeing some of that. And then the other is the effect that's working through the demand for the different inputs that go into AI, and that's creating an inflationary pressure, which would then need higher nominal rates, and that is also playing out. I think right now, I suspect that the real rate piece is more important. The inflationary part is being driven a lot by what's happening with energy prices and the pass through from energy prices into also core inflation. So I think that's the more of the higher inflation, higher rate path story is coming from other forces on inflation as opposed to what's coming from AI itself. And then you have the real rate path, which is going up also because of the general risky environment that we're in, but also because of what's coming from this increase in capital demand coming from the AI sector.
So, one of the reasons we wanted to speak with you is because you do have that very significant policy experience. And so, when faced with, potentially rising real rates because of an AI boom, what should policymakers be doing here? Because, certainly in the US, we've already seen some Fed officials or outgoing Fed officials start to argue that they can look through the AI boom and its impact on inflation. But if real rates are, structurally rising, if R star is structurally higher than it was before, is that the right move?
So, what matters crucially is what we believe are the main drivers of R star at this moment. Is it coming because of higher productivity growth, which is then leading to higher investment and therefore demand for capital? All of that is good as a kind of the good kind of increase in R star, because that's an economy that is projected to grow at a faster rate. And that helps. That helps on many fronts, including in terms of bringing debt to GDP down. The other reason R star is going up is because of the increase in fiscal deficits and just general high levels of government borrowing in the US. That is less appealing because that tends to be not necessarily growth enhancing. That the money that's being raised is not for necessarily productive infrastructure investment that's going to generate enough growth. So that's more problematic because it's just generating high R star without generating the higher growth that should come with it, and that can be a problem. From a policymaker's perspective, of course, you have to firstly be able to tell what is driving the R star. Is it a good kind or is it a bad kind? But regardless, if R star is drifting up and you have an inflation target of 2%, you are looking at higher nominal interest rates, right? So right now, the Fed has an R star forecast of about 1%. If you put 2% inflation on top of that as their target, we're looking at 3% nominal rates, which is a clear shift away from what it used to be pre-pandemic. Then you have to check to see whether the R star increase is actually slowing the economy down, or the increase in your nominal rates is slowing the economy down, and how much higher than that R star do you have to be able to bring inflation down, because there is obviously above target inflation in the US at this moment. That is now the big question, whether the AI productivity boom is going to mean that you don't need that much of a above R star interest rate, or do we have too many other forces coming from energy prices passing through into core inflation, the lower levels of immigration in the country, just general trade disruptions, supply chain disruptions, and those are the main drivers. In which case maybe you need to keep interest rates even higher. So being able to tease that apart is where, I think that's where the tough decisions are. But what is squarely the case is that we are looking at higher nominal interest rates, regardless of whether R-star is coming from the good kind or the bad kind.
There is this fantasy, and hopefully it comes true, but there is certainly this fantasy of a lot of people who are into AI, which I would think they would call like the disinflationary boom, right? So let's just imagine we have extremely powerful artificial intelligence that is capable of delivering incredible material gains for people. It makes healthcare really easy and quick. It can power robots that care for us. It can build things, etc. And meanwhile, the cost of commodities collapses. Maybe the cost of labor collapses. Is that a scenario in which it's worth contemplating and thinking about? So everything gets really cheap because it all gets super automated, but also our standards of living rise dramatically because the AI takes care of it for us. Is that conceivable? Like from from an economist's perspective, is there such thing as the disinflationary boom or the deflationary boom even?
So this is about making a distinction between now and what comes next.
Yeah.
Now, clearly, it is about the higher levels of investment.
Right. Clearly,
AI.
right now, it's pushing everything up. But let's imagine 10 years from now and we've done it. We have this incredible, and somehow we've solved all the sci-fi scenarios so that the AI doesn't want to kill us all, etc. Let's just imagine the rosy scenario in which we have this
I feel like there are some under-discussed risk factors in this outlook.
But right, like let's just say,
assuming the robots don't kill us,
assuming we solve that and the AI works on our behalf and it does what we want it to do, and it can create incredible material gains while also delivering it cheaply because it's just one AI, etc. Is that a contemplatable scenario from an economist's perspective?
There is absolutely a scenario where we could be in that wonderful place with higher productivity growth.
Yeah.
At the same time, we don't have civil unrest or,
right.
rogue forces using AI for ill. That is a scenario, but I do not know a single person who will put a probability on that scenario and say that that's going to happen, with a significant amount of certainty.
Yeah.
There is a very high degree of uncertainty, and there are several who also believe that it's yet to be seen whether there is going to be any major productivity gain of the kind that, there are analysts who believe that productivity could go up by 2 percentage points a year, over and above where it is right now, which is around 2 percentage points a year. That is huge. There is no evidence right now of that kind of a productivity wave coming through. Mm-hmm. So it's early, but I use the technology and I find it terrific. It's been really great for my own productivity. It's not affecting my wages or anything so far, but it's there. It is very valuable technology, but there is a lot of uncertainty, and which is what is very curious about the markets, right? Because on the one hand, it is impressive where the stock markets are, again, at close to a record high. And maybe one can explain that by saying that, well, there is a scenario where everything goes perfectly well. But there are so many other scenarios that could play out between now and next year or even 2 years from now. And you barely see that price being priced in markets. And I think that's frankly more surprising than just looking at what's happening with just the level of, of the stock market.
Okay, we keep talking about the stock market and, debt issuance in the corporate bond market and how everyone wants a piece of AI. Does that basically mean that we're seeing, I guess, maybe scarcity of capital versus the global, we used to call it a global savings glut in the early 2000s, right? Which ended up, per Bernanke, pushing yields lower. Does anyone still talk about a savings glut, or should we all be talking about, like capital scarcity?
No, we don't have a global savings glut anymore, and proof of that is real rates going up, interest rates going up. So that's that. What we certainly seem to have in the U.S. is, I don't know what to call it, but a gluttonous demand for U.S. equity.
Yeah.
Coming both from domestic investors, but also from foreign investors. We're at 40 trillion in terms of foreign holdings of US equities.
Wow.
That is at a historic high. Even if you look at it as a share of the rest of the world's GDP, it's about twice as high as what it was just before the 2000 dot-com bust, I guess, at the peak of the dot-com. So this is, the world has never been that invested in U.S. equity markets. It's like it's the only game in town. So if there is a gluttony, rather, I would say it is for U.S. equities. We're all in this together, and as we know, in terms of what's coming into the markets right now, we have some very big IPOs, and that will make us even more all tied at the hip when it comes to AI and stock markets.
Speaking of big IPOs, Tracy, this reminds me, and I'm saying this to a message to our producers, we should really do an episode soon about...
Are you including voice memos to
Yeah,
producers
I'm
in
now including
episodes
voice
now?
memos to producers. No, I really want to do an episode soon about the fact that all the big index funds are going to
Oh,
have
yeah.
to include companies at basically their peak, where you think, like, historically, okay, like a company like Apple, like it enters the S&P 500 at, I don't know, maybe a $20 billion market cap, and then it's a multi-trillion-dollar market cap. This will be the first time that the index fund owners are going to eventually have to buy these really big companies without having ever experienced any of the gains from the run-up. And I think that's like going to be a historic moment for both markets, indexing, and ETFs
This
and
has
passive.
been one of my long-running criticisms
Yeah.
of the big benchmark index
Yeah.
providers, which is like they always say that they're not making investment
Yeah.
judgments. They're just holding up a mirror to the
Yeah.
market. But like actually a lot of these decisions are like incredibly embedded with judgment
Yeah.
calls, and they do end up having an impact on the entire market.
Yeah, this is I think going to be a historic time for sort of index investing. Anyway, I know that this is a divergence. I just needed to get that voice memo into our producers.
Yes, but hey, there are now more ETFs than there are actually
Yeah.
companies being created on the market. So if you wanted to spend a lot of time picking and choosing, you could be selective too.
Yeah, I want to switch ETFs, but then I have to take a capital gains hit, so I can't. This is the anyway. We're getting pretty sidetracked here. I want to talk more. There are many phenomenons or many things going on at once. But when we think about these pressures, and it relates to AI, but it also relates to commodities itself, is this idea of essentially national resource hoarding and the decline of sort of free trade. And so the fact is, it's like, maybe at one point we could say, you know what? A country could say, you know what? It's great that America is building a bunch of fighter jets, so we don't have to have our own indigenous fighter jet industry, et cetera. How much, when you look at what's going on with the rates picture and pushing up inflation and so forth, is this phenomenon in which no country fully trusts other countries to deliver goods for them, and therefore there's a lot of replication or duplication of capital investment happening in every country all at once simultaneously?
We're seeing a lot of that. We moved squarely, firmly, decisively away from a pure efficiency-based model of I'm going to buy from the cheapest place and I'm going to sell if I'm the cheapest source, to one where everybody is building up their own capacity as much as they can. And of course, depending on the country and depending on how much of fiscal space you have, that can be a small group of things or a big group of things. For sure, energy security is everybody's paying attention to it. How do we make sure that we don't have to import fuel from the rest of the world, and how can we have our own fuel at home, either through renewables, whatever we need to do, or maybe just returning to coal for now. That is, we're seeing that. Defense expenditure, we need to be able to not just spend more on defense, but make sure that we can actually produce more of that, of the weapons that we need, semiconductor chips, rare earths. Yes, there are, I think there's so little trust in the world right now in terms of relying on your trading partners
Yeah.
that countries are just going to be spending a lot more on this. It's just that it depends on whether you're a country that can afford to raise the finances for it or not. And but everybody is heading in that direction. So if you look at the list of all the sources of demand for capital, that is a very, very long list.
Yeah.
And if you look at the sources of supply of capital, there's just one category, which is aging demographics. I mean, that's we often tend to blame old people for the fact that we need to spend so much on retirement and on health and uh, for their future. But the truth is, the reason interest rates are not much more higher than they would have been is because of the supply of savings coming from aging demographics around the world.
Well, you mentioned fiscal space, and I know you've talked previously about the need to, reduce some entitlement spending if governments are going to be serious about reducing deficits. And yet, we've seen numerous attempts in the developed world to actually cut back on government spending. And it seems very, very hard to do in elected democracies, right? Like, it is not a popular platform to be elected and say, what we really need is austerity for the longer term, and all of you are going to have to suffer in the near term. How are policymakers, like, realistically supposed to navigate that tension, assuming that they're up for election every 2 to 4 years?
I mean, we have the additional problem that I think policymakers actually are not really keen or particularly worried about where their debt to GDP is. If you look around the world, again, except for places where the bond markets are simply just not letting you do more spending, even in the US, I don't believe there's anybody in Congress who's truly worried. There are a couple in Congress who are worried about the US debt level, but not enough given where debt levels are and given the foreseeable path of spending that's happening. But again, it's to just step back and see, it's helpful to look at what has happened historically and when have countries been able and how have they been able to bring their debt to GDP levels down. It's a couple of things. One is just a spurt of growth that has come about either because you are some sort of a commodity exporter and you just had a positive terms of trade shock, and because of that, your debt to GDP
You hit the
comes
jackpot,
down.
basically.
Yes, exactly. You got lucky. Or productivity growth, a boom, higher, above average growth. And I believe that's what we're betting on this time with AI. The hope is that with AI, we will get growth from 2% up to 4%. And then that will certainly solve all of our problems if we have that on a persistent basis. But that's countries, especially developed countries, have tended to rely on that. And then you have inflation. If you go back even further, and also obviously right after the pandemic, inflation helped bring debt to GDP levels down. And then, of course, the third is what we see with developing countries is you end up with default and restructuring and crises. And then again, you bring debt to GDP down that way. So those have been this typical path. We've never had to worry about debt crises in developed economies, but now more and more, and I think this is also a new feature of the world we live in, is the developed world is moving into that space where their debt costs and their borrowing costs are far more volatile, far more sensitive to market conditions. I mean, the stark case is the UK, where you see that on a day-to-day basis. But, you see that in other countries too, in Europe, and some of it in France. And more generally, even Japan, where for the longest time we didn't have to worry about borrowing costs, those have squarely moved up. The 10-year rates have moved up. Germany's 10-year rates have moved up.
Yeah.
So everywhere we are seeing developed economies also now having to face higher borrowing costs. The US, I think, is still the exception in the sense that even though 10-year yields are at, say, 4.5% right now, just given the level of supply of debt and what's expected to come out in the future, I mean, markets are still treating it as giving it some privilege, even if it was not as big as it used to be in the past.
What does in your view, a debt crisis look like in a country that borrows in its own currency? Because obviously, like, technically speaking, we know politically maybe the debt ceiling doesn't get raised. There were certainly political ways to default, but economically, the U.S. never theoretically has to run out of dollars per se. In fact, I would say you would say it's the same thing with the UK. You'd say it's the same thing with Japan. They're not going to they can't run out of yen the same way that, say, an emerging market that borrows in a foreign currency could theoretically run out of dollar reserves, which is why we watch reserve levels when we talk about sort of on the edge emerging markets. To you, what does a debt crisis look like in an advanced economy in which all of its debt is denominated in its own currency?
A crisis in a developed economy would look more like a credit crunch that then leads into a financial crisis. So we would see a sharp increase in borrowing costs that will affect many other asset classes. You would see a slump in investment, the economy. So it's this debt overhang, high levels of debt, and that you have to roll over on a daily basis. That overhang, which slows growth, slows dynamism, that is what a typical crisis looks like. And yes, you can have financial crises. One of the wonderful things about the last several years, despite all the shocks, we haven't had a financial crisis in a developed world or in any emerging market, any big emerging market. And that has been very helpful to bring back a fast recovery of the world economy every time after every shock. And we talk about resilience. So in a case where we end up with just debt levels that are really high, it's just costs going up everywhere.
Yeah.
And that will eventually slow down economies, if not just trigger a financial crisis right away, given how sanguine financial conditions have been.
What happened? You mentioned that one of the things that's changed pre to post pandemic has been the change in marginal position of central bankers with respect to the bond market, and the fact that they've gone from being often, although even in the US, I mean, quantitative easing ended in the 2010s, et cetera. But what happens if, say, we talk about some central bank in one of these developed markets, and they say, you know what, we're gonna cap the long end. We're gonna buy bonds until the rates are held. They don't go above 2% or 3% or et cetera. Seems very plausible that something like that could happen in a developed market before too long. What would be the sort of fallout if a central bank explicitly came out and said we are going to buy government debt and just hold down the rates in a very explicit manner like that?
If a central bank comes out and says that we are, different from our mandate of price stability and full employment, regardless of what's happening there, if we are going to go out and buy long-term debt, then that's what's going to happen is you're going to see inflation expectations drift up, and then the nominal rates are going to go up. And real rates will also go up because of the risk associated with inflation. Premium will go up. And that will be, the end of the wonderful era that we've had of central bank independence, and that's helping to keep interest rates low. So that strategy just doesn't exist. You can play for it for a little while, but eventually it gets priced into markets. So, I mean, unless, of course, it is a tool for monetary policy because you've hit the zero lower bound, and you still need to stimulate the economy, then you do that. But right now, we are far from the zero lower bound.
We currently have the opposite situation. Right?
We have the opposite. So it is, countries have tried it in the past, and these are usually the countries that the IMF works with because they eventually find themselves in crises. But what typically happens is you get a tiny period when it looks like this is helping, and then you just get much higher interest rates, and you just don't get any of the benefits of the central bank buying your debt.
You mentioned earlier that we haven't really had a major financial crisis in recent years. And if we could just broaden that idea out a little bit, I think that the resilience of the global economy and certainly the US economy has been surprising to a lot of people. We've had multiple shocks, but overall, certainly in America, people just keep spending. Everything kind of keeps ticking along. Is there something that economists are maybe like underestimating when it comes to why it seems like, again, the global economy to a lesser extent, but certainly the US economy seems so resilient in the face of all these once in a lifetime shocks that we keep seeing.
There have been a combination of things that have helped, and some of it have been surprises. Again, since we're talking about debt, that increase in debt has come about because of the very large amount of support that governments around the world gave during each of these crises. So during the pandemic, I mean, advanced economies spent about 25% of GDP. If you look at the combination of not just outright support, but all kinds of loan guarantees and equity infusions and so on, that was huge. Those were much higher levels than anything we'd seen in recent times. And because of that, households and businesses came out of the pandemic with stronger balance sheets than they did going in. And that has helped hold up demand also, and also has therefore helps hold up profitability in a lot of businesses because of that strength that came from all that large amount of support. That was one. Second is the AI boom is a big player right now. I mean, if we didn't have AI and if we didn't have the increase in demand coming from AI, we would be looking at just much lower growth rates in many parts of the world at this time. And we would also see trade being much weaker. I mean, trade is being held up a lot by AI inputs flowing around. That's also been a big contributor. So we've had these positive offsetting events. The question is, what happens in the next crisis? In the next crisis, countries do not have the fiscal space to provide that kind of support, and we may see much less resilience than we've seen the last few years. I mean, I think that's something we should keep in mind. I don't think we should take this resilience as some sort of an absolute structural shift that keeps economies growing at their long-term trends, regardless of how big the shock is that's affecting them.
You wrote a piece, I think, recently for the Financial Times, which you talked about the Bliss Trade, I think as you called it. And can you clarify, because it sounds like, expand on this idea that there is this assumption of state support. There's an assumption of a backstop. Things go bad, the government will be able to do something. And this seems to be the core of your idea that this is mistaken.
We have this mindset right now in the policy world, and therefore people who are investing in markets, that the state is there to fix a lot of the problems. And we see it right away, even now. What's happening with energy prices going up is that there are many countries that are capping fuel prices, that are cutting energy taxes. The instinctive reaction is to protect households and protect their spending power. And when you do that, that helps corporate profitability, and that is going to be favorable for markets. So we've been in this environment now, either explicitly or implicitly. I mean, there has to be this notion that the economy has been resilient, and it is a reflection of the bliss, what I call bliss, which is big lasting state support, which has helped economies all over the world, not just in the US, but in many other countries. So the expectation is that will continue. And going back to where we started this conversation, just given how high debt levels are, that's just increasingly questionable, which means that I think governments are going to move towards far more unorthodox approaches, including price controls, financial repression, the kinds of things that we haven't encouraged in a long time.
We've talked about some of the big structural phenomenons in the global economy, the AI boom, demographics, certain things with trade. There's one thing we haven't really talked about, which is something I think about, which is that if a country makes something physical, there is a very good chance that either right now or in the future, China will be able to make it cheaper and better. And this is no matter what it is, there are still some things that aren't the case. The most advanced semiconductors aren't manufactured in China. Boeing and Airbus jets and stuff. There's a few examples, but by and large, when you think about the stresses that are being placed on economies all around the world, how much is this particular dimension a factor, the fact that like almost any tradable good might at some point be most efficiently originate from China.
Yeah, I read a lot of pieces on this that somehow the China will continue to run trade surpluses
Yeah.
because everything it produces for itself and produces for the rest of the world, and so that's that. I mean that makes little sense to me.
Okay.
Firstly, if you just look at China's spending behavior, they run a surplus on their goods trade front, but they run a deficit on their services trade front. And so one of the reasons why China's overall deficit, current account deficit or trade deficit, is around 3% of GDP as compared to like 10% of GDP before the great financial crisis, is because they are big consumers of services around the world. Chinese tourism has been a big contributor to incomes around the world, and the service deficit that they run. So just that, right? So there's no sense in which China ultimately gets to do everything. Secondly, usually if you get to a point where if you're so successful, if you're so good at manufacturing, making everything, you ultimately are going to have very high levels of investment. That, given the level of savings in your country, that usually means that you start running trade deficits, right? So it cannot be a story of China being very successful in its investment and being very productive, because any kind of a high productivity investment boom story means the country running deficits. What has happened in China is basically a lot of consumption suppression. Because of that, you're seeing surpluses that the country is running. And we're also now seeing all the problems of very high levels of investment that's come from the fact that the crash in the property market, which, despite the last 4 years of interventions and government policies, is actually looking quite bad. So the weakness in the property market, the weakness in consumption, if China is running surpluses at this point, it is because investment has dropped in China. You have that's come both from the property market crash, but also because of all the excess supply and the overcapacity that they've created. You've seen a decline in investment. So 2025 was the first year when investment in China actually declined. That explains why it's running a big trade surplus. Now, yes, there are a lot of exports coming out of China. Forget about the surplus deficit part, but just the fact that they're sending a lot of goods out of their country is a source of competition for manufacturers around the world. I believe that this is not sustainable. I don't think Europe or other Asian economies in East Asia are going to just say, well, that's okay. We are okay with China dumping all these goods on us. They're going to put tariffs on China. China is aware of that, which is also partly why they're trying to, see how they can manage their own exports to some extent. They will move in that direction. But I'm not a buyer of the whole China produces everything and does everything on its own, and somehow we still continue buying from China. That makes little sense to me.
Just going back to the beginning of this conversation, I mentioned a bit of a deja vu feeling because we do have these bond sell-offs from time to time, and we often record podcast episodes on them. And the idea of a debt crisis has also been a popular theme on many podcasts, not just ours. Do you have any sense of what a catalyst for, this actually exploding into a real life debt crisis could be? Or are there certain levels or numbers or behaviors that you kind of watch out for from here?
I think it's very important what's going to happen with AI and the productivity boom that we are hoping for. That is going to be very important. If it turns out that there is very little showing up in productivity from AI, or we have a setback that comes from just discovering that, there's so much of hallucination that it's just, you can't really use it for anything very important. If that's the case, then I could see a situation where the pricing of debt, it drops even more. It's a lot more concern about what's going to happen in terms of governments ability to repay all the debt that they have, and not just now, but that's expected to come into the future. So for me, that's one thing. I mean, it is important that there is growth in the economy and that growth is coming from good places. At this point, it seems like the growth is coming from AI investment and the hope that it's going to generate all that productivity growth. If that story goes away, we have a problem in terms of the concerns around fiscal positions around the world.
Gita, thank you so much for coming on Odd Lots. Truly the perfect guest for this moment in time. We really appreciate it.
Thank you. No, it was a lot of fun.
Joe, here is my overwhelming takeaway from that discussion.
Go on.
There is so much writing on AI.
Yeah.
Right? Like
Yeah,
honestly,
no, I
like
know. It's the
the
whole
last
thing. Yeah.
answer is like, whoa, it kind of all depends on economic growth and whether we get that productivity boost via AI.
Yeah.
Like the idea that the entire sort of Western economic
Totally.
model and I guess social compact with governments is now dependent on whether AI actually does what it says on the label, on the tin is nuts.
Yeah, I mean the numbers are obviously just extraordinarily big, and they're so they're affecting everything, and they're obviously it shows up in financial markets, but it also shows up in the real economy. It is a major force of sustained upward pressure. Yeah, I think there's no disputing that. It's like we have all become we're all watching along, sort of like eating popcorn and knowing that our fates will somehow, and I'm serious,
No, Gita said it really well, which
Yeah.
is like we're all basically in the AI trade together, whether
Yeah.
you want to be or not.
No, I know, and it's like, I look at my, like, very passively diversified, retirement money, and I'm like, "I'm such a genius these days," because it's like, because you don't even have to be an AI stock.
Conversely, though, do you feel pressure to keep
No.
spending on tokens in order to support equity market valuations?
Yes, I,
Oh.
like, yes, that's right, I keep, like, thinking of more tests that I
Yeah.
could do with AI because, like, "Oh, I need to make sure the tokens are boosted." No, it's really wild. It really is everything, and then I mean, and then the whole conversation is like, "Man, the last 6 years have been crazy."
Crazy.
Like, seriously. No, seriously,
I
like
have a voice memo for producers, which is we need to clip that quote of Joe going crazy.
No, seriously, you just think of all the things that have happened in the last 6 years. Whew. And so I guess I'm not surprised
Well, that
that markets did
also,
a regime shift during that time.
I mean, that also gets to Gita's response about this idea that like there is this assumption in markets that, well, we got through the last like 18 once in a lifetime crises
Yeah.
just fine. And so we'll manage to get through the next one. But then the question is fiscal capacity and I guess
Yeah.
political will.
It's both of those. And it's like, the way I think about it, and Japan, I think, is an instructive example here, which is that, like, when I think of fiscal capacity, I don't think of like a sort of like, oh, if you have 80% debt to GDP level, you have fiscal capacity. If you have 120%, you don't, because we don't know if there is that number. But what you do know, and what we can say, is that in a period of high inflation, and in a period where resources are already constrained,
Mm-hmm.
and governments have made a commitment, say, to seniors that that their standard of living will be X, and governments have made a commitment to so and so the defense that it's not going to drop below X. That once a lot of these certain sort of commitments have been made, if you get another shock in which you say, okay, God forbid, let's just say there were another pandemic in which a bunch of people we tried to do the same playbook again, and it's like, okay, we're going to replace your lost income for a few months. Well, at a time in which we're already very like resource constrained,
Mm-hmm.
you see how that just becomes, there's a lag period where like instantly
Yeah.
inflationary, because we're already that's the difference of in early 2020 and late 2019. We were not pushing against our real resource limits in the way that we appear to be right now.
Yeah, I think that's right. Okay, well, on that happy note, shall we leave it there?
Yeah, let's leave it there.
Okay, this has been another episode of the Odd Lots podcast. I'm Tracy Alloway. You can follow me at Tracy Alloway.
And I'm Joe Weisenthal. You can follow me at The Stalwart. Follow our guest, Gita Gopinath. She is at Gita Gopinath. Follow our producers, Carmen Rodriguez at Carmen Armin, Dashiell Bennett at Dashbot, Cale Brooks at Cale Brooks, and Kevin Lozano at Kevin Lloyd Lozano.
And for more Odd Lots content, you should check out our daily newsletter. You can find that at bloomberg.com/oddlots.
And you can chat about all of these topics 24/7 in our Discord, discord.gg/oddlots.
And if you enjoyed this conversation, then please leave a comment or like the video, or better yet, subscribe.
Thanks for watching.